continue talking about the markets. We want to get the big picture from Steve Wood. He's Chief Market Strategist at Russell Investments. He helps manage $155 billion in assets. Good to have you back on the close. It feels like, again, the same problems we continue to talk about, whether it's Europe, whether it's the concerns here in terms of the fiscal situation. You still think the market can have an okay year in the United States?
I think it could be an okay year. I don't think it'd be fantastic. But if you're looking at relative opportunities, the U.S., even for what we've been through, has held up a lot better than the rest of the world. And earnings, you were talking about earnings earlier, estimates are going to decelerate. We've known for a while that they're going to come down. That said, the S&P's doing really well in terms of earnings per share.
But have those earnings estimates really come down? Do they truthfully portray what's going to happen maybe for the rest of this year? I mean, David Rosenberg says that's what's going to be the big surprise to a lot of investors. He says it's going to be earnings contraction. That will be the big surprise. Are we still too optimistic about our earnings expectation? And you expect a 13% gain in the market from here. Is it based on earnings?
Well, and is it going to happen by the 31st of December? Somewhere in there towards the end of the year. Is it going to be based on earnings? I think predominantly. I think the multiples are compressing right now. I think earnings are going to decelerate, but I think they're probably going to stick reasonably close to where they are right now. Our earnings numbers were never all that aggressive to begin with coming into this year.
Right.
So we feel comfortable thinking that the United States, from a corporate perspective, looks reasonably healthy. We've got obviously macro issues that are affecting us from Europe, and they're creating a lot of volatility in the market, a lot of fear in the market, but ultimately interest rates and earnings are going to be a driver of equity prices.
As we talk about this, I think about what's going on in the consumer, and that's kind of, the president, of course, talking about job creation, which we hope that will flow back to the consumer. Sheila, I want to bring you in at this point because you are looking specifically at the consumer. There's a lot more talk out there about how consumers are really having a difficult time right now.
Yeah, that's absolutely right. But I mean, the big picture for right now is in terms of consumer discretionary stocks, they've actually held up okay. I mean, they are down for the year, but they still have been outperforming the overall S&P index. But slowly we are starting to see more and more signs that the consumer is getting frugal. In fact, David Rosenberg had a quote that said something like, consumer frugality is really concerning investors. One of the things that a lot of people look at is the restaurants, right? The restaurant index, how much people are going out or how much they're staying in, and what that perhaps means about their habits. One of the things we found in a Bloomberg restaurant index was that full-service restaurants, so like an Olive Garden, like a Cheesecake Factory, where you actually go out and sit down for a meal, they are down 21% since July, versus the quick-service restaurants, so the fast food players like a McDonald's or a Wendy's, down only 5% since July. So my question to you is, are we seeing more and more pressure on the consumer? And if so, is consumer discretionary the place to be? I know you're interested in those stocks.
Yeah, that is one of the areas. Consumer is something that we've liked for a while right now. And we've known about consumer frugality for a number of quarters. So this is not a new theme for us. But looking in, a risk-adjusted portfolio, the consumer's not dead. They're just going to be deleveraging. So I think there's an okay opportunity there. I think it's going to be a little bit better than other opportunities within the market if you're looking at sectors. But within risk assets, we do like the consumer. We don't love a lot in this environment, but just lean into it a little bit in terms of the consumer not being 6 feet under just yet.
I have to say I would be more cautious, and maybe that's just because obviously I work in the financial industry. There's talk about Bank of America cutting 40,000 jobs. Obviously, you see people on Wall Street laid off every day. I'm going to be a little tighter with my money next time I go to Olive Garden. Like, I'm not going to, order 3 courses there. Don't you feel the same way? I mean, aren't consumers across the country worried and sort of stocking up in case they get fired, in case they need to?
Matt, it is all the soup and salad you can eat, so it's not such a bad deal. And the breadsticks. But Matt brings up a good point.
Yeah, I think so. But we've known about this for a while. We're in a deleveraging environment. Consumers are going to be saving a lot more. They're going to be spending a whole lot less. But this has been something we've seen for going into our 4th year. So I think
is it getting worse?
I don't think it's going to deteriorate aggressively. I think we're just going to bump along where we are. And you and I have been talking for a while. I know Matt and I about that square root-shaped economic recovery. So we came in, we had a nasty recession 2.5 years ago. We've recovered, and you kind of plateau out. Some quarters being better, some quarters being worse.
Right.
I think that your viewers and investors should get used to what they're seeing. They've seen it in 2010, again in 2011, and I think they're going to see it in 2012. Kind of that bumpy. It's not a recession, but it's certainly not going to be a brisk economy either.
All right, so I'm getting a little bit of confidence from you. And speaking of confidence, Bloomberg's Peter Cook sat down with Treasury Secretary Tim Geithner for an exclusive interview in Marseille this morning. The secretary telling him that there's plenty of confidence in the United States. Listen up.
If you look at the reactions of markets around the world, to even the pressures we're under right now. There is enormous confidence around the world that this country, our country, is stronger than our political system looks today. We got to get the political system to catch up to the underlying strength of the economy.
But the trillion-dollar question, can the political system catch up, in terms of the strength that Treasury Secretary Geithner sees in the economy? Can the political system catch up based on what we've seen as of late?
I think the market is voting with its dollars. I mean, look at what's happening in government bonds right now, not only German bunds, but in the U.S. So safe haven, relative to your options, I think the United States and Germany look pretty good.
So the cleanest dirty shirt, we go back to that.
Exactly. But also in America, I mean, it's not always pretty how we make decisions, but unlike Europe, we can make decisions. In Europe, it's not clear that they can have the capacity to make decisions at all. Whereas here, the debt ceiling process was kind of messy, but we arrived at a number, and we've got a process to get there. So I think in the United States, ultimately, we've got a long time to solve the problems, and our problems are solvable. That's not necessarily the case in Europe.
At the meantime, though, we get nervous about what's going on in Europe. Julie, let me bring you back in here, because you've been following the Europe effect on the markets today, and it's been a big effect.
It has been a big effect, and of course, not just today, but really over the past year and a half that we've been looking at this effect. And what's interesting is that it's not just limited in any way. It's not limited to the sovereigns. It's not limited to the European banks. It's not limited to the U.S. banks. But one of the other ways I've been looking at it is the difference in bond CDSs here in the U.S. and in Europe. In other words, it's not just sovereign default that folks are more worried about. It is company default as well, corporate default. So look there, that's the European corporate bond credit default swaps, insurance against any kind of default, versus here in the U.S. That is a record gap that we have seen between the two. Now, to be fair, the European index that we look at there includes banks. The U.S. index does not. So that does account for some of the gap. But Steve, I'm curious to ask you, when you look at this whole situation here, where does the contagion stop if indeed you do see Greece default?
Well, things are going to be very, very dicey in Greece, and it's not clear to me how that's going to unwind well. But you're right. If you're looking at the likelihood of corporate failures in Europe, they're pricing in the numbers I saw this morning, 35 to 45% default rate, which is very high. But that's also a number similar to what we saw in the United States in the depths of the 2008-2009 crisis. A lot of that is financial driven. But I think a thing that's going to be a little bit different is I think Lehman really caught everybody by surprise. That systemic risk caught the market flat-footed. In Europe, we know that there's going to be something that has the potential to be rather big. It's not going to be as startling in our opinion. So I think what we saw to Merkel this morning is probably what we're calling Le Tarp, to go in, to recapitalize the banks, to kind of ring fence around them and just kind of allow the financials to weather the storm. I think you're seeing that in there. The question is, which is the financial that is probably going to get hit?
We got to run. I love it. Le Tarp. I love it. Steve Wood joining us, Chief Market Strategist over at Russell Investments. Have a great weekend, Steve.
Thank you.